Time for Mike on the Money, and we're so happy to have you here today for all the reasons, but especially this is a big day. It's Fed Day, and today the Federal Reserve decided not to raise interest rates. However, they did leave the door open to raise rates further if necessary. So we're happy to have our friend Mike Giordano, financial advisor with Williams Wealth Management here. Okay, so why did the Fed decide against hiking rates again?
Well, as we've talked about over and over and over again, the Fed's trying to land this plane or, get the car off the road at the right time, hit the exit, not blow past it. And so they've just been trying to slow down. So they've kind of been hiking every other meeting now. And that's so that what they want to do is if they feel like the conditions are met for inflation coming down, they don't want to ruin the economy. So they just want to hit, exit stage right. They want to hit the exit properly. And the only way to do that is to really slow down enough that you can kind of gauge the conditions as they're happening. And so that's what they're doing. But as you mentioned earlier, they did say they may have to hike again later this year. So they didn't say they're done hiking. And more importantly than that, they said rates will probably stay higher here because they don't expect to cut interest rates anytime soon.
You're saying this move should be good for borrowers.
Yeah, this can be good and bad for borrowers. It's good that they didn't hike rates, right? So that's good. The problem for borrowers is that it doesn't look like they're going to be cutting rates anytime soon. So it's basically a stabilization situation now. And as you can see, I mean, like credit cards, home loans, auto loans, all these things have spiked upward, and everyone's waiting for some sort of relief. And it doesn't look like it's going to come really anytime soon.
All right. So what about for our investments? You're saying today's higher rates could be okay for the investments?
Yeah, so it depends on what kind of investments you're looking to buy. If you're a coach, you always like to have maximum amount of plays. If you're a football coach, you want to have a good passing game, a good running game. It's the same thing as an investor. You want to have different options in order to try to get the returns you need with the least amount of risk. Well, over the last 10 or 15 years, bonds have paid you absolutely nothing, and so you basically had to plow most of that money into the stock market. Now bonds are have a higher yield to them, so all of a sudden now you've got more options. You have stocks you could buy, you have bonds. So higher rates are not necessarily good for stocks, but they can give you better opportunities with bonds, and so you have more options in your tool belt.
All right. We always like to leave people on a positive note, right? A good takeaway.
That's the point of the segment, is to make people feel good.
Make people smile.
Yes.
So, Mike, what is a simple rule of thumb then for deciding which type of investments to hold on to?
Right. So you have to think about your own risk tolerance and how much volatility you can handle. Volatility being the ups and downs that you're going to see in your accounts. Beyond that, though, if you're investing for things you need over the next couple of years, you want to do a new home renovation, you want to buy a new car, you want to buy a new home. That kind of money needs to stay in cash or very short-term bonds. The stuff that's further out, 3 to 5 years, you can put that in longer-term bonds. And then the money that you're not going to need for the next 5 years, typically those are monies that you can put in the stock market. Again, all balancing off of your risk tolerance and how much volatility you can handle.
All right. Good stuff. Thank you so much.
Does that make you feel good?
Always, yes, absolutely.
I missed it last week, so
we did. You have a nice time off.
It was wonderful. Went to an investing conference out in California. Learned a whole lot of stuff. It's all about the future.
You will share it with all of us every Wednesday.
Week. Yes.
Thank you, Mike. We'll be right back.